Good afternoon. My name is Lisa Wilson. I'm a mortgage loan officer with the Land of Lincoln Credit Union. Today we're going to talk a little bit about preparing to buy a home. With interest rates being substantially low right now, there's a lot of people contemplating whether to continue renting or if now's the right time to purchase a home. But there's a lot of different things you need to consider before making that decision. Some good points about buying a home is you do build equity into that home every time you make a mortgage payment. And then you do get some tax deductions, like with your mortgage interest that's paid at the end of the year. But the downside is you do have to take on some additional cost that maybe you don't have to as a renter. Things like home repairs, maintenance, homeowners insurance, property taxes, things of that nature. So before you make the decision, you need to sit down and kind of look at how much money you will be spending as a renter versus how much it's going to cost as being a homeowner. If you're not financially ready to make that decision, you might want to then put a plan in place for maybe a couple years down the road. But typically you want to stay in your home for 5 to 7 years to justify any upfront costs and closing fees that go into the purchase of a home. So think about your future as well, any employment changes or relocation. If you're not going to be staying in this home for 5 to 7 years, again, now might not be a good time to purchase. First thing you need to do is look at your credit. Credit scores are the number one thing that we need to look at. Most lenders will need at least a 620 credit score for any kind of a conventional loan. There are other loans out there that are government-based or government-backed. They may need a little bit larger credit score. So again, make sure your credit score is at least a 620 or higher. Also keep in mind that the higher the credit score, you might potentially get better interest rates. So, it's a good thing to have as high of scores as you possibly can. If you're not sure what your credit scores are, I recommend that you use some of the credit monitoring applications that are out there, like Credit Karma, Credit Sesame. Even though their scoring models may not be exactly what we mortgage lenders use, so your scores may not be exactly what we see when we run your credit reports, but it'll at least still give you kind of a guide and give you a good estimate of what your credit scores look like. It also gives you a chance to see what inquiries and what things are being reported to the credit bureaus on your behalf, and show you what's kind of weighting down your credit score if it's a little low, or potentially what might be giving you those high marks of bringing your credit score in a positive direction. If your credit score is a little low and you're needing to do some work, there's a lot of different ways that you can do that. And just to keep in mind, here at the credit union, we do have financial credit counselors that can help you and give you some advice and assist you with that. But just some things to kind of touch on, reducing debt. If your debt to income ratio is a little high, maybe you want to focus on paying down some credit card balances or paying down some loans. Continue to make your payments on time. Every time you miss a payment, even if it's 30 days late, that is a negative remark against your credit report, and that will continue to bring your credit score down, and that stays on your credit report for several years. So you want to make sure you're hitting those payments on time. Eliminating collections, that's another big one, and a lot of times people don't realize that there are medical collections on their reports. A lot of times I'm the one that points it out. So unfortunately, even medical collections can bring down your credit score. This is again where if you go back to the credit monitoring applications, or even go out to annualcreditreport.com at least once a year, see what's been reported on your credit report. That'll give you a good idea to see what's there, give you a chance to maybe clean up what's there, or dispute anything that you find that's maybe not yours. It could be fraud in that sense as well. But a variety of instruments on your credit report are going to be helpful. Credit cards, loans, auto loans, mortgage loans, whatever it be. Having a variety is really your best solution for improving your credit scores. And just by focusing on some of these improvements, you'll be surprised how with just as few as 3 to 6 months, you will see your score increase and possibly get you to where you need to be. Now I'd like to talk to you a little bit about the pre-approval process. The best place to start, and this is the advice I usually give everybody, is start with getting pre-approved. That means coming to speak with me or another mortgage lender, talking through the process, understanding what all it's going to take during the application process, and then all the way to the closing. But the pre-approval is a great way for the lender to help you identify just how much money you are qualified to borrow. In a sense, this will also help you determine what you can afford and also help you see if it's a comfortable monthly payment and something that will fit into your monthly budget. Because even if you can get approved for a certain amount, that doesn't necessarily mean that you want to take on the responsibility of a mortgage payment that high. So I always like to hit it from both directions. What is a comfortable amount that you can pay each month? And then once you get the pre-approval letter, that is going to just give you more buying power. A lot of realtors, especially in this area, they don't even want to start showing you homes yet until they know you've been pre-approved for lending. Number of different reasons, but for one, it's an inconvenience for the seller to have to get their home ready for someone to come walking through if they aren't potentially able to buy the home. Not to mention it could be unsettling for you as well. Maybe you get your eyes set on this home and then you later find out it's something you can't afford. So it just kind of wastes a lot of time. So your best thing is find out what you're pre-approved for and then go from there. To get pre-approved, the things that we're going to be needing would be an application. There's a universal application that all lenders use. We have one online on our website, and then we also have a paper copy as well. If you need assistance filling that out, I most certainly will sit down with my borrowers and help them fill it out. Again, I want to make this process as simple as possible and do whatever we need to kind of put them at ease. In addition to the application, there are going to be some documents needed to support your assets and your income that you state on the application. So we're going to need like the last 30 days of pay stubs. And this has to have your year-to-date salary on there as well. Again, it just gives us a running total of how much money you're making and how much you're making each month. We need your last 2 years of your federal tax returns with all W-2s. We need all pages. And we need the actual W-2s that are produced by the employers. And we need the last 2 months of bank statements. And this is going to help support what kind of money you've set aside for things like closing costs, down payments, things of that nature. And then there may be some additional items depending on your situation. If you receive Social Security benefits, disability benefits, retirement benefits, there'll be some benefit letters that we will want you to bring in. And then if you receive child support or pay out child support, we would need the court documents showing how much you're ordered to pay or receive. Generally, that's the main step that you have to bring in. Mortgage loan officers like myself will take all that information, we'll run it through our underwriting system, and the system's going to look for some trends and some certain things to look to see if you're a strong potential candidate for a loan. One of the things being at least 2 trade lines in the last 12 months. And what I mean by trade lines is 2 credit trade lines, 2 lines of credit. So that could be 2 credit cards, 2 loans, a credit card and a loan, one of the combinations, but they're looking at that credit report to see, are there 2 creditors out there that you have been making payments to for the last 12 months? Again, they want to see that credit history and that on-time payment history to just show that more than likely you're going to pay us on time as well for the mortgage. Then they're also going to look for your 2-year work history. A 2-year work history is just a way of verifying that maybe you're working at the right place. Maybe you have longevity with that employer, so hopefully you're going to still be with your job tomorrow. We've got to think ahead and look to see what the risk is of you not being able to make those payments. So if you've been consistent, working at the same job or at least in the same industry for the last 2 years, it shows chances are your job situation is stable or your employment stable, and that's a good sign. You can hop around within your industry from different jobs and it still will be fine, but the main thing is you don't want to jump from different industry to different industry. It just shows that maybe you're a little unsettled, not quite sure what you want to be doing, therefore we don't know what your potential of income is in the future. One exception to the 2-year history is maybe a recent college graduate. If you take on a job in the field of study that you just graduated from college, they will consider that the same as a 2-year work history, because again, you have basically applied yourself to that industry or to that degree for the last 2 years. Now you're going into a job in that field, so they feel like there's commitment there, and chances are it's a job that you're going to stick with ongoing. Stability of your income and wages. Last year with 2020, I know a lot of employees did see a decrease with their income, and that's understandable. Luckily, Fannie Mae, Freddie Mac, the powers that be that back these loans, they understand that last year's circumstances were a little different. But for the most part, we want to look to see that hopefully whatever job that you are in, you are increasing that income year after year after year. Especially if you're in a sales job and you get paid on commission, if we see that over the last few years it has slowly been decreasing, then that's going to be a concern that we need to address. Now, what we do is we take the liabilities from your credit report as well as your gross monthly income, and we try to calculate what's called a debt to income ratio. So that's all your minimum payments for your loans, credit cards, things of that nature that you're required to pay, in addition to what a potential mortgage, which would be principal and interest plus insurance and taxes, would cost in a monthly period. We take the total of the debt divided by that gross monthly income, and that gives us your debt to income ratio. Lenders, most loans want to see at least no more than a 43% debt to income ratio. Again, the government says we have a ceiling that we have to go by, and that's potentially the ceiling. They want to make sure that everything above and beyond that is for everything else that you need to consider: food, clothing, gas, things of that nature, things that you need to survive day to day. So that's why they don't want you to overcommit or overextend just because you're buying a house. One important thing I get a lot as well is on the liabilities on the debt is, what about student loans? Lately there have been a lot of student loans that have had deferred payments, a lot because of COVID. Even if they're deferred, we still have to take them into consideration, because at some point throughout the life of this loan, we can expect that you're going to have to start making payments on that loan again. So if we know the estimated payment amount that you will be required to pay in the future, we will use that. But if it's uncertain, then we're required to take 1% of what that current balance is and use that as an estimated payment amount each month. And that gets added into the debt to income. So again, when you're looking at numbers, keep in mind, even deferred student loans have to be taken into consideration. So basically after that, we would get you approved. The good thing is a lot of the rules for the different types of loans are similar. So with that information, now would come the time that the mortgage loan officer would try to help steer the borrowers into which loan type is maybe best for them and fits their needs. We're going to look at, again, for one, your work history. We're going to look at what kind of money you've set aside in your savings account, or what money you may have available as a gift from a family member to be used toward a down payment and closing cost. There are different loans that require different amounts of down payments. The traditional thought was always you had to have 20% down for a mortgage loan. Well, thankfully, that's no longer the case. You can actually, depending on where you're located, in the rural counties like here in Effingham and some of the surrounding counties, we are eligible for the USDA Rural Development Program, and we do write a lot of those down in this area. They are income-based, so we have to be careful, but it's a 0% down payment loan. Which is a great option for first-time home buyers or anyone that doesn't have a lot of money put aside in their savings account. Now, in counties like Macon County, unfortunately, the USDA Rural Development does not allow them to participate in the Rural Development Program. So they're going to have to look to other options, like the FHA loan. Still another great loan, but their minimum down payment is 3.5%. And then your regular conventional, traditional, if you're not wanting to go with one of the government-backed programs or it's not the best solution for you, you can get a conventional loan for as little as 5%. So again, as you can see, depending on how much money you have, we have several options that will fit your need. Closing costs, though, are pretty much always going to be there. The rural development's the only one that there may be a possibility of rolling that into the loan, but the other ones, closing costs are going to be consistent. So again, depending on where you're located, you want to put aside $2,000 to $3,500. And this is where your mortgage loan officer can best guide you as far as approximately what your closing costs are going to be up front. So it's really important for your mortgage loan officer to understand your whole need and be able to give you recommendations on what loan type they think fits best for you and give you the pros and cons of each type of loan. After you have your pre-approval letter, this is when you want to go ahead and start working with a realtor. You may already have someone in mind that you want to work with, and that's terrific. If you do not, ask friends, ask family, ask colleagues, or ask your mortgage loan officer for trusted recommendations. We work with realtors all the time. I'm sure other family members as well. So listen to their good stories and their bad stories, and hopefully that will help steer you in the right direction. It's a great idea to work with a realtor versus for sale by owner. Now, by all means, you can go through directly to an owner to purchase their home. But when you go with a realtor, they know the market. They can help you analyze what you're looking for, what your needs are, what location you want to be in, what size of home you need, whether you need a basement, things of that nature. So they can help narrow down some selections and get you in those homes that hopefully will give you some to choose from. They also know the purchase contracts. They know the state laws. You're taking on a lot more risk unless you go through an attorney if you don't use a realtor. They can help you with drawing up the contracts. They can help you with the negotiations to get the best deal for you with that seller. And then they can also help you with setting up some inspections. Home inspection is usually not required by mortgage loan lenders. However, it's strongly recommended because the inspection is going to help you find and uncover those hidden problems that lie in that house. If there are any kind of costly problems, you want to know about them before you actually purchase a home. This is the way for you to go back to the seller and ask that the seller maybe help with some of that expense. So they can help with coordinating that as well. Once you have a signed contract, you're basically going to give that then to a mortgage loan officer or give it to myself. We've already got all the other documentation from you. We've got you pre-approved. Now we've got your contract, and that's typically what starts the ball rolling. That starts the loan process moving forward. It's about a 45-day window from that contract application process until when we close. So there's a lot of pieces that have to happen within those 45 days. The mortgage loan officer and the realtors, we take on most of that responsibility to make things happen. But there are going to be a few things that we need from you. So, maybe it's reviewing some of your documents and signing them and getting them back in a timely manner. You'll have to get homeowners insurance lined up, so getting that done in a timely manner. So it's important for us all to communicate and stay on top of things so that when your closing date comes around, things go smooth, you're ready to close with hopefully no hiccups. While you're in the underwriting or processing phase, you do not want to consider job changes if you at all can help it. Job changes, avoid taking on new debt, whether that be credit cards or loans. Those are some negative things that potentially could throw your pre-approval out the door. Again, if you've changed jobs to a different industry, unfortunately that may stop the underwriter in process and they may say you're no longer eligible. Or if you've added too much debt on, your debt to income ratio now may exceed the 43%. So in essence, that could throw your pre-approval out the window too. So avoid doing any of that until after you've actually closed the loan. Now I'm going to kind of talk a little bit about home inspection and home appraisals. Like I said, the home inspections are important. We do recommend them, but they're not required. A home appraisal is going to be required, and it is ordered by the loan officer. This is what's going to confirm the value of your home. When you write up a contract to purchase, it is based off a market value. The realtors are really good about knowing the market and the estimated market value of that home. But the appraisal is what truly determines the true value of that home. So we are hopeful, and usually it's accurate or pretty accurate, but we're hopeful that the appraisal comes in at or above whatever the market value or purchase price is of that home. So we will do the appraisal after the loan process has started. Things to consider when you're at closing. Prior to closing, you will do a last walkthrough. There'll be some loan documents to sign, and then you will usually close at a title company along with the seller. There'll be some title work and some things like that that you'll need to sign. But again, the process runs pretty smooth if you have a loan officer and a realtor involved. Try to take on most of the work and the headaches for you. So thank you for your time today. I hope you found this session informative. If you would like to regularly receive notifications of our financial advice videos, please like and subscribe to the LLCU channel below. Thank you.